All right, it is Friday, 11 o'clock. I'm feeling good. Um, so this episode, actually, it's not an episode, man. I have podcasts on my mind. If you're not aware of it, um, I participate in a podcast called Growing Money with Sean Trace, and the specific um, segment is called Money School. So if you're interested in learning a little bit about money, I use my textbook, which you can see just like right there. We go over the concepts of my textbook in that podcast. But I'm also in the process of starting my own podcast, which is called Money Misfits. And it's basically talking money with individuals who you would never assume are really interested in talking about money. Or maybe they are, but they're not the typical money expert guests. Um, I talked to a really good friend of mine who smuggled drugs into Australia, got caught, spent about 5 years in prison, but he later bought his own house and he's currently, trying to figure out how to retire. I have a lot of other interesting guests in mind, but it's essentially taking a bunch of misfits, telling really cool stories, and folding in um, financial advice and good, sound financial information. Because usually it's the case that individuals that are sharing really good, sound financial information generally tend to be very boring. And then the interesting individuals generally tend to share terrible advice. And so what I'm really trying to do is combine the two, the best aspects of both, right? Which is sound financial advice and information and literacy in the context of really interesting stories, and really dedicated to a segment of the population that doesn't typically, or they're not typically targeted for financial services and financial information. Skaters, right? Musicians, ex-cons, first generation in your family to go to college. Like that's not necessarily a misfit, but again, it's like typically they fall under the radar of most financial information podcasts and information. So anyway, it's been a fun journey. If you're interested in participating in any way, please reach out to me. If you know somebody who would be a great guest, I would love to hear from you. But anyway, back to chapter 6 of our homework. In this particular video, not episode, we're going to cover determining the product selling price and analyze special orders. Okay. So again, this falls squarely within absorption costing and variable costing. When we are thinking about, is there a way that I can, yeah, there we go. So when we're trying to set the price of our product, um, we want to start with absorption costing. And what we're saying is we want to include all costs associated with delivering our product to the market. So it's all the variable cost of manufacturing. It's also all the fixed costs of manufacturing. And then in addition, it's all the variable and fixed costs of operating expenses. If I'm spending money, trying to employ a sales staff to deliver the product, or delivery individuals delivering the product, all of that needs to be accounted for in the price of the product. Okay. So to determine for the long run, the right price, typically I'm going to start with the absorption cost, like the cost to actually make the product and then deliver it to the market. Determine the target markup, right? So it's going to cost me something to make the product. How much more what's my profit? What do I want my profit to be? And then you add the profit to the cost to make the product and then deliver it to the market. And that's how you set your selling price. Okay. So in the examples that we were using in some of the previous lectures, we were saying, hey, the full absorption cost for our product is $25. Okay. That's the variable manufacturing. So it would be direct material, direct labor, variable manufacturing overhead. Then it would be a per unit fixed manufacturing overhead. And then in addition to that, we would also even want to include variable and fixed um, selling and generally administrative expenses. Okay. But in this particular example, we are actually only looking at product costs. Very interesting. Okay, so then if my product costs are 25 and I want a 60% of the cost markup, meaning if it's costing me $25 to make it, I want to mark it up by 60% of that. So I'm going to mark this product up by $15, and therefore the selling price is going to be 40. Theoretically, the 15 is going to cover the SG&A. So the real margin that we're making, it's not necessarily $15 on this particular product. Because again, we have variable selling and generally administrative expenses, et cetera, et cetera. So this is how we set the price in the long run. If we want to like continue to make money, we obviously have to cover all costs. But what happens if we get a special order? Okay. And I don't really like this slide. So I think what I did is I said, hey, what if we get a special order and somebody comes along and says, hey, we want to buy your product and we're willing to pay $23. It's a once in a lifetime opportunity. This client is saying to us, we're never going to buy from you ever again. It's just that this one instance, we do want to purchase whatever it is we're making, and we're going to like purchase it this one time, and then we're never probably going to come back. Nothing nefarious, but we just, we only need it this one time. And so as a business manager, I'm sitting here wondering, boy, should I sell my product if it's costing me $25 per unit, including all absorption costs? Should I sell it for 23? Intuitively, we would think, no, we shouldn't, because if it's costing me 25 and I sell it for 23, I'm going to lose $2. However, if I really stop and think about it, there are all sorts of fixed costs that I'm going to incur no matter what. If I say yes, actually, if I say no, I don't want to service this particular sale, I'm still going to incur all of my fixed costs. And then if I say yes, I'm not going to incur any more fixed costs. And therefore, in this special price analysis, we actually want to tell ourselves, boy, you know what? It doesn't make any sense for me to factor in the cost associated with my fixed overhead because I'm going to incur that either way. And so I really should only be looking at the variable costs, right? So I went and I took some of the information from some of the previous slides that we used to talk about the differences between absorption costing and product costing. Bear with me. Come on now. There we go. Oh, here we go. Okay, so what I did was I said, okay, if my total cost is 25 and we're thinking about selling it for 22, the relevant costs that I want to think about are really only the variable. So the direct material, the direct labor, and the variable manufacturing overhead. And to me, that's looking like it's going to be about $15. So if I say yes, right, I'm going to make $20 per unit. It's going to cost me an additional 15 per unit to make because these costs are going to be incurred no matter what. And therefore, I could stand to make $7 per unit. So I think I would want to say yes. That's special pricing. Now, there's all sorts of complications associated with it that we don't need to get into specifically in this chapter. We will probably address those in a later chapter. But man, what if I'm typically selling my product? What did we say we typically sold it for? We typically sell it for 40 to like my best customers. What if my best customer found out that we just sold the same product to a nobody for $22? My best customer would get pissed off, and therefore we could stand to lose some of our business by selling our products for cheap in these one-time instances. Okay, so again, the analysis isn't totally complete, but we do want to at least appreciate that when we are thinking about special orders, the cost that we would want to think about would just be the variable cost. So we would use variable costing. When we're thinking about setting the price for our products for the long run, we obviously want to use absorption costing so that we account for all costs.